Hey, welcome back in. Interest rates, of course, trending lower. The Fed recently deciding to lower rates a little bit once again. So what should you do then if your company says, you know what, we're going to offload some pension liabilities, offering you a lump sum pension payout? Should you go ahead and take that option or do something else? Here to join us with a little perspective and analysis on that for you is Marshall Clay with the Wealth Group here. Good to see you this morning, sir.
Good morning. How are you?
Yeah. So we saw that. Now the Fed said they're probably not going to lower rates again, but everything that could change. But now these companies are trying to offload some stuff. So what should you do? What are some things you could consider if they're saying, hey, we're going to give you this lump sum option on your pension plan?
Yeah, so I love coming in here and giving advice that's sort of blanket advice for everybody, but this is truly case by case specific. Okay. So when you're going down the list of things to think about, the first thing you want to do is obviously look at your options, right? Okay. And so they're offering the lump sum option, but they're also still offering the traditional defined benefit pension option. Okay. And so that can be taken over a single life, which is typically the employee. It can be taken over the joint life, which is typically the employee and the employee's spouse or significant other. And then sometimes they'll offer a third option, which is a time period certain. So they'll say, look, we'll give you that monthly payout over a 10 to 20 year period, for example, whether you're alive or not. So understanding the options is really just the first step.
Should you get a lot of help with the benefits calculations, or do they do that for you so you have it laid out? Or
yeah, so whether it's the lump sum payout or the monthly payout, that's all done by actuarial tables. And so those actuaries are essentially creating those benefits based on the average life expectancy. So understanding how they make those calculations can help you determine which option to choose. So, okay. For example, if you're someone who has a really long life expectancy, everybody in your family lives till their late 90s, it's not always the case, but it may be the best option for you to take the monthly pension payout. Okay. If you don't have a long life expectancy or you're ill, it may be better off to take that lump sum payout up front.
Okay. So what are a few other things we should consider if we're in that position?
So really it's about establishing priorities. So when you're confronted with this decision, you want to see what you value. So do you value the consistent stream of income that a monthly defined pension payout will provide, or do you want more control over your assets, which the lump sum payout offers? Also, probably one of the biggest considerations is what other assets do you have out there? So if you elect the monthly payout, you have to operate in a pretty strict budget. Okay, so if there's a big lump sum expense that you have and you don't have other assets to address that particular issue, you're sort of stuck, right? Because you're locked into that monthly payout. The last thing to consider really is just what your risk tolerance is. If you're someone who's very risk averse and you're saying, even if I get this lump sum payout, I'm just going to put this thing in cash or really short-term bonds, I'm not really going to do anything with it, I would probably recommend leaning towards the monthly payout. But if you're looking to get a little bit more aggressive, maybe invest some of that money in stocks to get some more growth longer term, maybe the lump sum option is better for you.
Some good advice there if you're in that situation.